Welcome to vTalkInsight, Market Drivers Daily for May 22nd, 2026. Energy shocks from the Strait of Hormuz, an AI-fueled equity boom, and higher for longer interest rates are colliding, and the way those threads weave together could be far more important for portfolios than any single data point. The core macro story today is that the Strait of Hormuz disruption has hardened into a structural shock, yet pricing still leans toward a quick diplomatic fix. Negotiations between the U.S. and Iran have made only limited progress, with disputes over uranium stockpiles and Tehran's proposed toll regime unresolved, even as Iran discusses formalizing a fee system with Oman. At the same time, the U.S. asserts that it will keep the waterway open, has turned away dozens of tankers under a naval blockade, and European allies mull a security mission without a clear timeline. This standoff is feeding directly into energy and inflation dynamics. Physical oil flows remain impaired, with a material share of global daily consumption reportedly not shipped, and oil product exports out of the U.S. increasingly needed to plug gaps abroad. If Hormuz stays constrained into the summer, estimates suggest global GDP could take a meaningful hit via higher inflation, while scenarios of OECD inventories falling toward roughly 2.2 billion barrels imply a risk of crude prices retesting or surpassing recent highs. Stress is already visible in projections of Brent potentially spiking toward the $175 area, which would push U.S. gasoline well beyond prior peaks and intensify consumer and political pressure. The distributional effects are stark across regions. Energy importers in Asia look especially vulnerable. Persistent Gulf export disruptions risk rapidly draining inventories, while China, despite ample domestic stockpiles, is not expected to buffer neighbors in a major way. Emerging market currencies show this split clearly, with exporters like Brazil and Colombia benefiting, even as importers such as Korea, Thailand, and the Philippines grapple with heavy FX pressure and, in some cases, rate hikes or interventions. Turkey sits at the sharp end of this stress, facing record lows in the lira, forced asset sales, falling equities, and policy steps to tighten domestic funding in an effort to stem capital flight. In Europe, policymakers have sharply revised inflation assumptions higher, citing persistent energy shocks from the Iran conflict and warning of slower growth in coming years. Yet the base case remains one of continued, if weak, expansion supported by temporary fiscal cushions and confidence that targeted subsidies can smooth the adjustment. More broadly, equity and credit markets still embed a relatively high probability of a benign outcome, with many participants assuming that some combination of diplomacy and U.S. supply will normalize conditions. The tension is that each additional month of disruption causes cumulative damage to trade, fertilizer supply, and consumer real incomes, so the bar for a clean re-rating of risk assets may require visible de-escalation, not just an absence of new headlines. The main counter-argument is that recent dips in Brent from earlier highs, signs of ongoing U.S. diplomatic engagement, and talk of a peace framework involving Iran suggest we are closer to resolution than to a new spike. Under that scenario, a reopening of Hormuz, relief on fuel prices, and a step-down in inflation risk could catalyze a sharp rotation away from U.S. AI-heavy leadership toward under-owned energy importing markets in Europe, the UK, and parts of Asia. However, several assessments still flag that markets are underestimating the odds of either a protracted partial closure or renewed escalation, which could instead trigger a volatility shock across EMFX, rates, and risk assets. The near-term watch list, therefore, includes any concrete change in tanker traffic, clarity on Iran's toll proposals, NATO and European security decisions, and fertilizer price trends that could foreshadow a broader food and inflation story. Turning to equities, AI is still the engine of global risk appetite, but the leadership keeps getting narrower and more complex. The S&P 500 major U.S. indices are pushing toward their longest winning streak in years, with nearly all gains driven by a small cluster of AI and semiconductor names. Recent moves in chipmakers, in some cases surging well over 100% in weeks, underscore both the strength of the earnings impulse and the buildup of concentration and valuation risk. Asian tech is now tightly plugged into this cycle as well, with indices in Japan and Taiwan making new highs led by AI-exposed names such as SoftBank and leading foundries. Under the surface, the economics of AI are shifting quickly. Unit costs for inference have collapsed compared with last year, which in theory supports ongoing margin expansion for firms deploying large-scale solutions and helps justify the surge in capex on models and infrastructure. At the same time, the physical footprint of that infrastructure is creating its own set of constraints. Individual data centers are now projected to consume energy on a scale comparable to a meaningful share of a small country's grid, and the scramble for power, cooling, and land is drawing utilities, industrials, and even unconventional locations into the AI value chain. Leadership within the AI complex is also evolving. Investor focus is starting to rotate from a handful of mega-cap hardware providers into upcoming IPOs and higher growth infrastructure stories, with potential offerings from major model labs and space launch firms seen as a test of public market capacity. Enthusiasm around proxies like SoftBank and select CPU providers reflects a surge for second and third order beneficiaries, while some incumbents with AI narratives have actually underperformed, showing that not every company talking about AI is being rewarded. Meanwhile, ancillary sectors such as power equipment, building systems, and battery storage are quietly enjoying strong momentum as the market absorbs the scale of data center demand. The bull case is that accelerating enterprise adoption, coupled with collapsing compute costs, eventually translates into tangible productivity gains and durable earnings beats. Recent results from software and infrastructure providers that have integrated AI into their offerings lend support to that view, as do reports of robust AI-driven revenue growth at some pure-play names. But there are important caveats. In many U.S. corporates, adoption rates are rising again after last year's pause. Yet hard financial benefits remain patchy, leaving open the risk of investor fatigue if monetization lags expectations, just as infrastructure bills and energy costs ramp up. On the downside, regulators are paying closer attention to AI-related rallies, particularly in markets where speculative excess appears to be building. That adds another layer of uncertainty on top of already stretched multiples, heavy reliance on cyclical advertising budgets in parts of the AI ecosystem, and rising leverage among some fast-growing firms. An additional risk is that a geopolitical resolution in the Middle East could change the macro backdrop in a way that undermines the current AI leadership, if falling energy prices and a less stagflationary narrative prompt rotation into previously lagging cyclicals and regional markets. The key watch points now are the timing and terms of blockbuster IPOs, the evolution of power supply constraint for data centers, and whether upcoming earnings seasons continue to deliver the 3 times earnings momentum that AI-linked sectors have enjoyed so far. The third pillar holding this narrative together is the global rates backdrop, which has swung decisively toward higher for longer. Long-term yields across the U.S., UK, Europe, and Japan are sitting at, or near, multi-decade highs, with U.S. 30-year benchmarks back above 5% and 2-year yields trading above the policy rate. In the U.S., incoming Fed leadership and recent remarks from key officials point to a committee that is more hawkish than markets had assumed at the start of the year. Several voices now stress that the funds rate may still sit below neutral, that traditional hikes remain the preferred tool if inflation re-accelerates, and that removing the easing bias is a near-term priority. Energy and geopolitics are feeding directly into those policy choices. Gasoline and diesel prices have jumped sharply year-to-date, while physical oil shortages linked to Hormuz and other supply frictions raise the risk that headline pressures bleed into core inflation through food, packaging, and transport costs. Central banks face a classic stagflation dilemma, especially as wage growth lags prices and political pressure to ease mounts. Emerging markets are already being forced to react. Indonesia has delivered sizable hikes. The Philippines is debating off-cycle moves, and several Asian economies are intervening in FX to stem record lows despite a softer U.S. dollar. In Europe, the picture is one of reluctant tightening. Authorities acknowledge that repeated energy shocks from Russia and now the Gulf are likely to keep inflation elevated for longer and have raised medium-term projections accordingly. Even so, there is a preference to delay any further rate increases until later in the year, given fragile growth, weak industrial output, and pressure on rate-sensitive sectors like construction and chemicals. For the Fed, the risk is that hesitation to signal a clear tightening bias or a failure to align guidance with market pricing could damage credibility and force more abrupt action later should inflation expectations drift higher. Rates markets are wrestling with two overlapping risks. One is a potential policy mistake, where central banks either under-tighten in the face of persistent shocks, allowing inflation to re-accelerate, or over-tighten into a slowing growth backdrop amplified by high energy costs. The other is term premium, elevated deficits, large AI and defense-related capex, and uncertainty about future balance sheet policy are all contributing to higher compensation for holding long-duration bonds. Against that, some participants argue that the adjustment toward higher real yields is more a return to a normal equilibrium than a crisis, and that eventually, as energy shocks fade and AI-driven productivity improves, the bias could swing back toward disinflation and lower rates. For now, though, the balance of risks around inflation and rates remains skewed to the upside, even if the base case still allows for disinflation further out. Equity markets have largely shrugged off the rise in yield so far, helped by strong AI-linked earnings, but there are early signs of sensitivity as 10-year benchmarks approach prior stress levels and financial conditions tighten. Credit and EM assets sit at the intersection of these forces, facing both higher funding costs and vulnerability to any further deterioration in the Hormuz situation. The key indicators to watch from here are upcoming Fed communications under the new chair, the evolution of rate cut or hike pricing in futures, the behavior of long end real yields, and whether consumer and wage data confirm that policy can remain on hold or instead force another leg of tightening. To wrap up, the intersection of a fragile Hormuz situation, an increasingly concentrated AI-driven equity rally, and a higher for longer rates backdrop is creating a much tighter linkage between energy, earnings, and discount rates. How those three forces evolve from here is likely to drive the next phase of cross-asset performance, whether that means continued AI leadership, a rotation toward energy importers, or a repricing of duration and credit risk. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.